Now on to our Did You Know segment for today, which is going to be primarily educational. We are going to talk about escrow accounts. Before I go into that, I'm going to make a note. If you make a deposit on a contract when you're purchasing a home, there's an escrow established. And normally that's held by an attorney or a real estate company that's managing that transaction. That's part of your deposit on the contract. That's part of your down payment. That is not what I'm talking about. What we're going to be talking about today are escrow accounts for purposes of servicing your mortgage, particularly taxes and insurance related to your property. So for the first-time home buyers out there, starting out, when you close on a home, you're going to be making payment at closing for prepaids and putting money into an escrow account. The prepaids are going toward paying things like your first year's annual homeowners insurance premium. You are required to pay for that at closing. That secures your insurance policy for the next 12 months in that property. So now you know, and the lender's aware and has that policy on file to know that you have insurance on your property. Great. If you don't have insurance on the property, or if you let that lapse for whatever reason, then the lender has to do what's called forced place insurance. That's not a situation you want to get in. When you escrow taxes and insurance in your mortgage, you don't have to worry about that. The mortgage company, the mortgage servicer has money that is going to be paying that, and you're setting up that account at closing. The other element of prepaids is taxes. You will be making a payment for taxes, some sort of prorated amount, depending on the state. I'll talk to New Jersey. This is where I primarily do business. We have quarterly taxes in this state. So that means when you're closing on your home, you're either going to be paying for the next quarter of taxes at closing if it's due within 60 days, plus any per diem, so any per day cost of what taxes would be from when you take ownership of the property to the end of that tax quarter. And you're reimbursing the seller essentially because the seller would have already paid those taxes, or they may be paying it at closing, so it's a function of the numbers there. Now we're going to actually get into the escrow account part. It's not prepaids. This is setting up the account that will hold the funds for payment of your taxes and insurance into the future. Here are a couple quick notes on that. Number one, you will be putting in a 2-month buffer. Lenders are allowed legally to hold a maximum of 2 months worth of taxes and insurance in that escrow account to ensure that there are funds available to make payment on taxes and insurance moving into the future. As we all know, taxes and insurance go up. So to avoid there being a shortfall, or to avoid there not being enough money to make payment on taxes in the future, if there are increases, they have that buffer established. Secondly, your mortgage servicer is the one that manages that escrow account. So when you get your mortgage statement after you close, you will see that there. You will see what the balance is. You will see on your mortgage statements when payment is made for taxes and insurance. That's the transparency that's provided to you so that you're aware of what's being paid for your property. Thirdly, you'll notice that there may be another month. So you may have 3 full months of taxes and insurance being collected into your escrow account. The reason for this is that mortgages are paid in arrears. So you're going to pay at closing your closing costs and down payment, and you're going to close. Let's say you close toward the end of the month. Let's say it's January 28th and you close. Your first mortgage payment will not be due until March 1st. So you're prepaying the interest to the end of the month. We've talked about that on past episodes, but you're also putting that 1 month for February into that escrow account so that when you get to January of 2026, you will have 12 months of homeowners insurance that's in the escrow account and ready to make payment. For taxes, that will depend on where we fall in the quarter and whether or not you're going to need to put that extra month in there, or if it's just going to be a 2-month buffer if you're paying for the next quarter at closing, if it's due within 60 days. Every year, your lender and mortgage servicer is required to provide you with what's called an annual escrow account statement. This shows you what the current balance is, and they are legally required to let you know if there's a shortfall based upon what the updated taxes and insurance figures are for your property. If your insurance premium goes up, if your taxes go up, you may be required to add money into your escrow account. This is important, and this is a common question that I get. If you have a 30-year fixed rate mortgage, it's the most common mortgage, your monthly payment's not going to change for your mortgage. Principal and interest. Your rate of financing is fixed, your monthly payment is fixed. However, when you're escrowing taxes and insurance, part of your monthly payment is taxes and insurance. And if those go up, your mortgage payment could go up. So that is one part where you could possibly see a change in your mortgage payment. When you get this annual escrow account statement from your mortgage servicer, it's going to notify you of any shortfall. If there's a shortfall, then you have two options. Option number one, you can make a lump sum payment so that you can pay up your escrow account so there's sufficient money for the 2 months reserves for taxes and insurance, buffer we'll call it, and then also enough for payment moving forward. The second option is if you don't want to make a lump sum payment. A lot of times this is the automatic option that most servicers default to. You have the opportunity to spread out the payment for funding that escrow account over the next 12 months. And that will increase your monthly payment. And if you do that, there could be a little bit of a doubling effect of how much that's increasing your payment, or a compounding effect, I should say. That will mean that if your taxes and insurance have gone up, then the amount for taxes and insurance that's being collected on a monthly basis is going up because it's higher now. And then on top of that is the additional charge, or collection rather, of the money that's required for your escrow account. So you can really see probably a little bit more of a meaningful increase in your monthly payment if you elect for that second option.